Welcome to the Restaurant Boiler Room, Season 6, Episode 8. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, I'll be sharing my thoughts as a panelist at the Restaurant Finance and Development Conference, known as RFDC, in a panel entitled Accelerating Growth, Strategies for Franchisee Acquisitions. I'll also share some general perspectives from the conference. The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities affecting the franchise industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, and large investors and franchisors on a monthly basis. Feel free to find all of our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room. Well, as you hear this message, I want to first give a shout out to you guys who have been hanging in here with the Restaurant Boiler Room. We're almost at the end of Season 6. I mean, I can't believe it. Man, how time flies, huh? So I'm going to keep doing it. It's been just a blast to do it. And so we'll be creeping up here on Season 7 in 2025. And sometimes I kind of listen back to some of the old episodes, and it really creates kind of a portrait or a painting of time, what our industries look like, of kind of our perspectives on the industry. And the industry's changed a lot over a couple of years, especially from like 2020 on to today. So thanks again for listening. Quick update on business. You know, the M&A industry really was slow and quiet as crickets prior to the election. That shouldn't be a surprise to anybody. But I think, I do sense some significant amount of optimism from the election. Maybe some of it is just the general knowing of what the future is going to look like. The rest of it could potentially be that a lot of the, small business owners and people in this country who operate restaurants and franchises tend to like low taxation, low rate regulation, pro-growth, pro-business policies. So there's I think this quiet amount of optimism, kind of like a breath-holding optimism that our industry may kind of come out of what's been a very difficult three and a half years at the end of 2021 till now. So today I'll share a little bit about my perspectives on the Restaurant Finance and Development Conference. So we'll go through that a little bit, and then maybe just some other broad perspectives too. Happy Thanksgiving as you hear this, and Merry Christmas, which is coming upon us here in a few weeks. I hope you have a blessed time over the holidays, and we get ready to go get it in 2025. Okay, so the name of the panel that I did was called Accelerating Growth, Strategies for Franchisee Acquisitions. It was a Tuesday mid-morning panel at RFDC. I mean, I'm not sure exactly how many people were there, but I think I heard a number that was in the 4,000s. So for those of you who listen who haven't attended, there's a lot of advisors and lenders and franchisors and a lot of people who support the franchise, mostly restaurants, so franchise restaurant industry. But there are some franchisees there too. And it really is just a nice place to establish some connections, to hear some industry trends, to get to know some people, see old friends. I think I've done 20 of these now. Can you believe that? I'm 50 years old this year. So, I mean, goodness gracious, 20 of these conferences. And it was in Las Vegas. I was telling somebody after 20 years of doing conventions in general, maybe going to Vegas twice a year for 20 years, times 3 or 4 nights each time, I am rolling on almost 200 days in Las Vegas in my life. When people talk about days being like dog years in Las Vegas, I've certainly lived it. But I'll tell you, my claim to fame is that I've only bet $5 one time in Las Vegas in 20 years. Not because I'm a prude, maybe just because I don't like the math of gambling, but I lost $5 on a Kentucky basketball game a couple of years ago when they were playing Duke. And so that was the only time I bet in all that time out there. I know that's a random aside, but yeah, this convention is fairly well attended. The way that it starts like midday on, usually around 2 p.m. Local time, which is Pacific time on Monday, and it ends on Wednesday around noon. And so usually Tuesday is the meat and potatoes of these panels. And there's maybe, I don't know, I'm just stabbing in the dark here, 10 to 15 panels. And for the third time in a row, I'd been asked to be a panelist on what I hear was one of the most popular breakout panel discussions. It's been moderated 3 years in a row with Nick Cole, who's a senior lender at MUFG. And then I've been on it for the last 3 years. And then it's been mostly franchisees along with me to talk about the M&A industry. This year we had the other franchisees were Neil Yadav out of California, who I think he said he has 550 restaurants. He owns a couple of small franchisors like Nick the Greek, and then he's a big Jack in the Box franchisee as well as other concepts. So he's done extraordinarily well. He's out in California. And then Greg Grambling of Guernsey Holdings was also with me, and they own maybe 120 or so Sonic drive-ins. And then they also became a Zaxby's franchisee and own about 20 or so Zaxby's. And Guernsey, we helped Guernsey sell their Little Caesars, roughly 30 Little Caesars units in the Midwest earlier this year. So they exited that brand. So it was a really good discussion. Our panel was full. So I don't know how many people that was, probably, at least 300 or 400 or more were there, and it was full. And so I'll share kind of some of the questions that were asked of me and then some of my responses. My hope is that this is maybe a 20-minute time period here for you all. So it'll be a little shorter than normal, and then we'll sign off after a few final thoughts. The first question was, what is the state of the M&A market this year versus last year? Where are you seeing the most activity, brands, geographies, and types of situations? That was the first question. And so here's my answer. So Unbridled projects our revenue to be up about 5 to 10% versus 2023, and maybe around 15 to 20% versus 2022, which puts us still really, while on the surface that may sound like, wow, things are looking up and doing well. And we are doing well, but we're still really well below our 5-year average, even a 5-year average when you pull out 2021, which of course was an enormous outlier with the amount of activity that there was. So, we're kind of climbing out of a low base. We're still probably, what's normal anymore? I don't even know how to say that, but maybe a normal year, we're probably still 15 to 20% below what a normal year would be. And so we project to sell at Unbridled businesses in 9 different brands this year, up from 7 brands in 2023 and 6 brands in 2022. I think there's a message here that kind of can be across the whole industry. It's kind of, for us this year, we've been doing broader work with less concentration in any one individual brand. In the M&A world, in buying and selling anything, whether it's houses or bowling balls or cars or businesses, whatever in the heck it is, you usually have a contingent of people who sell things that are kind of sort of independent of timing. So I don't know what that percentage is, but I've always kind of said like a fourth to a third of people sell things that it has no correlation with a good time or a bad time to sell it. They just sell it. So maybe that's because there's a death or divorce, or they're tired, or there's a change in circumstance in their family, or a health diagnosis, or, there's just a number of reasons why someone might sell something other than trying to sit with their finger on the button to time it perfectly or to get out at the right time. And so I think there's been a little bit of that, for the reason for the kind of the diverse, more broad work across more brands, but less concentration. I think the other comment too is, and I've been saying it for a while now, that if you have, and I'm going to talk a little bit more about this, but if you have a really good business, whatever your business is, there's not a lot of really healthy businesses that are available for sale right now. And so you kind of can dictate when to sell your business if it's really good, because a good business will sell no matter what. It's kind of like having a beautiful home on the water in Florida. It doesn't matter that interest rates are 6.5% or 7%. If you've got a unique asset on the water that everyone's going to want, they'll find a way to buy it at whatever the price is, right? That's kind of another perspective. So as I look back into the kind of the kick up in terms of the number of brands that we've been operating, that's clearly a factor too. Our geographical spread, which was part of this question, continues to remain 80 to 90% in the southern states, and then in non-solid blue Midwestern states. It's just the way it's been for us. And I think I'm thankful for that. Obviously, I'm from Kentucky originally and live in the Gulf Coast of Florida now. So I traverse between that area, those areas of the country anyway. But I think clearly those are the places where our franchise industry is doing the best, with some notable exceptions on the West Coast and then, in the Northeast, clearly. But that's where most people want to buy businesses, especially businesses of scale, and operate them in those types of areas of our country. The FAST Act legislation has made California transactions difficult, if nearly impossible, in 2024, except for a few key brands that have had just tremendous growth. And so I think, it has been a year in California where minimum wage has gone up so much, and there's just been so much uncertainty of what it would do to the P&L. Obviously, operators cannot raise the prices as fast as the minimum wage has increased. Clearly, there is sagging consumer demand in many of the brands too, even out in the West Coast. And so raising prices at all has been a challenge. So a lot of the increases in wage rates have had to be stomached by franchisees who've been dealing with sagging consumer. And so because of that, the P&L has looked questionable, and anytime you have uncertainty, what does that create? It creates a situation where people don't want to buy something or will discount it too much. And so that has happened. The good news maybe for California, although, I think I would only say limited good news for trying to sell a business or buy a business out there, would be once you have those wage rates built into the P&Ls in a year or two, and everything is hopefully smoothed out and ironed out, I would guess the uncertainty at least would mostly go away. Whereas in some other states around it, and for the moment, mostly blue states are talking about introducing legislation that's similar to California. I would rather always have the known than the unknown at this point once you have your business managed appropriately. That's for your California transactions. So another item of note for this year that I think is notable for us, at least, is that we typically derive 80 to 90% of our business from founder-led franchisees who want to sell their business. Okay, or borrow money, or raise capital, or buy businesses. But this year, about a third of our business has come from private equity and family office sellers who wanted to exit as their investment time horizon sunsetted. So that's kind of interesting. For the last, I guess the phenomenon kind of started happening in 2014. Sure, it happened in the late 90s and the early 2000s when I first started getting in the industry. You started seeing small private equity groups and family offices get into the restaurant business, especially, which is probably 70 to 80% of the franchise world anyway. But it was in I've talked about this before. It was in small amounts and it was kind of gradual over time. And I cut my teeth in the Yum system as working for the Yum franchisor and KFC, and Taco Bell and Pizza Hut, and at the time Long John Silver's and A&W. And so that was kind of the brands where you started to see it initially. And so I kind of got that learning when I worked there. But really you started seeing the acceleration of private equity and family office in 2014 and 2015. And you had some panelists out there from Garnet Station, Alex Sloan and Matt Perlman, and they talked a little bit about that. And they were guys who came out of Harvard Business School and, grabbed a bunch of Burger Kings and operated them successfully, and then, sold them to Carroll's, and, also, and they've done big and great things after that, mostly now buying franchisors. But that kind of big wave happened in 2014, 15, 16, and 17. Well, that puts us in 2024 at the end of 7-year fund lives, doesn't it? Especially the companies that got in 17, 18, and 19, especially the private equity groups want to hold these assets for between 5 to 7 years and then sell them. And so that business has picked up a little bit for us. We had a couple of those transactions this year. And then we've had a couple of family offices, one in particular that is a third generation, 60 plus year franchisee. The third generation had a board of maybe 7 to 9 people, and they kind of made the decision to move on from their investment and, liquidate it and put their assets in something else. And so those decisions have happened this year. I think we'll see that continue in 2025 because, frankly, a lot of the private equity groups are going to hold on to their assets and try to time their exits as best they can to monetize a gain, because that's what they're in the business to do. And I think they haven't been able to do that as successfully in the last couple of years. So we'll see that probably unfold a little bit in 2025 and 2026. In terms of brands, Wingstop has gone bananas this year. You've heard of some bigger deals happening. I mean, Unbridled's done like, I think 4 deals in Wingstop in the last couple of years. The multiples are crazy, 10 times EBITDA or maybe even a little more at times. And that's also, just so you know, somewhat independent of the size of the transaction. And people think that you have to amass a $100 million EBITDA business with 200-300 units in order to get that multiple. And it's not really true. Even the smaller businesses are attracting that type of multiple too. So it's really a one size fits all approach to these crazy Wingstop valuations with 35 and 40% sales growth. My goodness gracious, this year, and lower cost of goods with wing prices. It's just been an unbelievable boon. And I was actually out at the Wingstop convention, which coincided at the same time as RFDC. So I was out there for the first 2 days of over the weekend, of last week, and then bumped over to RFDC for the last 3 days. So I was there for 5 days and 2 conferences and felt like a zombie by the time I left. But the optimism in the Wingstop brand's amazing. You have a lot of, small to mid-size operators who are becoming larger operators and are growing a lot. And it's a crazy system because it feels like probably the go-go days of the 70s and 80s when you would meet a franchisee one year and you'd say, "Hey, Bill, how you doing? And how many stores you got?" And he's like, 14. And then you'd see him the next year, "Hey, Bill, how you doing? How many stores you got?" 21. And like, "Hey, Bill, how you doing? How many stores you got?" The third year, and he's got like 40. And it's like, what on earth? But the unit economics and performance has been so strong. That brand's talking about trying to be 6,000 global units. And I think they may have, I'm not sure, maybe around 2,000 now. So franchisors typically want more development than what's reasonable or feasible, but directionally they're planning and plotting to become a big, powerful brand. And obviously, I'm a sports fan, so obviously, if you watch sports, you've probably started to see their commercials, probably more so than most other brands, right? So they were a big talk. The brands that are also doing well. I mean, there's plenty of emerging brands that have been really exciting that have been posting these massive AUVs. And so that continues to be a trend. I mean, I could sit here for an hour and name the brands, but there's probably 30 or 40 different brands that are starting to emerge that have had a lot of success. And I define a lot of success as maybe an average AUV that's like $3 million or so, and so they have small unit counts, but keep your eyes on these things. Or ones that maybe have $2 million AUVs like a Wingstop business does, but does it in a small footprint and does it with pretty high, margins and low development costs. So those brands, I think, are getting a lot more attention than maybe some of the legacy brands. Taco Bell continues to be a name that you hear that's a hot brand that's blowing through the hallways at RFDC. And those brands have tons of buyers at high prices, as always. But we have the story in 2024 of struggling brands and struggling consumer demand. I mean, same-store sales in the industry have been kind of flattish to down. Transactions have been really brutal. Some brands are seeing transactions, the amount of customers coming into the stores down as much as 10 or 12% this year. I mean, even Starbucks has seen some massive decreases in consumer foot traffic, dealing with competition and riding their ship with new CEO Brian Niccol, who came originally from Taco Bell and then Chipotle. But pizza has struggled badly this year. Some of the big pizza brands have posted really negative sales. I think we saw Papa John's posting almost -6% same-store sales. I think the time frame was Q3. I mean, we saw Pizza Hut come out with like -1%. I mean, it's just been kind of languishing this year. Some chicken and some burger brands have struggled, and certainly casual dining has been a really brutal place to be. There have been some notable exceptions, and my friend Kevin Hochman, who's the president at Chili's, seems to have been bucking the trend with some crazy positive performance and results, and good for him and good for that brand. I always loved their wings, by the way, man, when I was growing up. So I always liked the Chili's brand. So they're doing something right, but a lot of the other ones have been struggling. And so sales, like I said, and transactions are down. In many cases, that it's being hit with a double whammy, which EBITDA is down, and some of the transactions we're seeing, not transactions, just some of the businesses that we've seen 200 to 300 to 400 basis points in margin over 2023 because of cost inflation and, and wage and, cost of goods. And so, I mean, when you're losing, call it 2 to 3% on your bottom line, when your bottom line after paying your debt service is only 7 or 8%, I mean, that's meaningful, man. That's like 30 or 40% down in profitability. I mean, forget about selling something. If you're just trying to operate it, you're lean and you're tight. But my encouragement is momentum comes quickly, and I think I'll talk a little bit about it in a minute. I think it's going to come, maybe not immediately, but it's going to come quickly, I believe. And then, when times are gray and when it's a little bit darker, when it's not raining, right, and you're in a little bit of a drought, that's usually when you can get your operation strong and tight and be ready for the wave that's going to come with some positivity, and then you can profit on it. So my sense is that while Unbridled is doing pretty well in 2024, I think from just listening at the convention and, kind of sniffing around and such, talking with people, especially lenders, you peel back their general positive aura and you ask some specific questions about how many deals have you funded this year. And I think what you kind of hear is that it's been a really difficult year and many deals are not closing because of valuation expectation. If anything, this might have been the year 2024 of the year where deals didn't close, So there have been a lot of deals just kind of sitting like a kind of a rotting fish on the marketplace for a long time with unresolved kind of situation. And my pitch over the years has always been this: you don't want to be the guy or the girl to have a business on the market that sits there like a fish and starts stinking and doesn't sell. Not only does that, and people who sell things don't naturally think of this, but it is so true that if you put a business on the market that sits there and languishes and doesn't sell, you become spilt milk in a hurry. And it's kind of a self-fulfilling prophecy. You go out there, let's say your house, and your house is worth $500,000 and you put it up for sale for $700,000, and it sits there and it sits there and it sits there and it sits there. And then really what ends up happening was it might have been able to attract $525,000, right? But because you priced it at $700,000 and it sat there for like a year, now your house will probably never get more than $450,000 or $475,000. And it's just because most people will just bypass it, look over it, and not come back to it because they thought it was unreasonable the first time. So there's a very real negative reason to be undisciplined and come to the market on bad information. I mean, I'm telling you, it is a bad decision. The other thing that happens with deals don't close, clearly, is that the longer you're out there, the more your employees find out about what you're doing. And when they do that, guess what? They've got other opportunities on the next street corner to go find another job, especially restaurant managers, which are the heart and soul of this business. Without good restaurant managers, businesses like ours don't run at all and don't run profitably. So when they leave, you have a mess on your hands. So I guess the final comment I would make to this question was we expect at our company the valuation gap that is causing these businesses to sit and not sell to lessen by mid-year of 2025. That's a guess, and the guesses have been wrong. I mean, clearly one of the laughing jokes was, hey, everybody, you all said last year at this convention that 2024 would be the year of turnaround because of all the pent-up demand of people not being able to sell things in 2022 and 2023. And clearly we're kind of missing the boat on that one. And I got to say, yeah, that's right. I mean, while I just told you that our revenues are up a little bit, it's still probably pretty protracted. So 2024 did not end up being as strong as we had wanted it to be, clearly. And we didn't see the rebound that we had wanted. And I think there are reasons for it. But, one was probably the surprising drop in consumer traffic in 2024. That was clearly one of the reasons. The second question that was asked, and I think there were a total of 3 questions, right? So this is the second question in the panel at RFDC that was asked of me, was for engagements you had in the last year that didn't transact or that struggled, what were the main obstacles, and are there any consistent themes? Well, let's see. I said that most of our deals transacted. So we continue to try to deliver, and we have been delivering about a 90% success rate. If we take 20 assignments, we're historically going to close 18 of them. 18 out of 20 is 90%, right? So you can't be perfect. You can't pick the right client in the right situation every time. There's things that are unforeseen. But most of the time, we represent healthy clients in the sale, financing, or acquisition of businesses in healthy situations with growing brands, and that's our model. So it's important to know that, and also know that in 2024, our company turned down over 40 assignments. I mean, can you believe that? So usually when we do evaluation with a client, they call us and they want to know the value of their business and kind of understand their options and talk about timing. I would say like half of the valuations that we do typically end up in in an assignment, and probably in any given year, we don't come to alignment with maybe 10 to maybe 15 potential clients. This year it was over 40. Can you believe that? So that number is very telling. And so while our success rate is at, 90%, and I think we're the best at what we do, we screen really hard on the front end and don't take deals that have big valuation gaps when we can, avoid it. And I think that's the message in this first point here is that by having that many deals that we turned down, there was just a persistent valuation gap in the marketplace. And this was across all franchisees across almost all brands and almost all geographies and almost all situations. And there are a number of reasons why that is. But the two primary reasons for a valuation gap, and typically in our company, I mean, if the gap is 10 to 15% or more above what I think it's worth, that's where we typically say, thanks, but no thanks. Let's monitor and come back and talk again. Now, probably if we turn down 40 assignments, I mean, maybe a third of those assignments went somewhere else and got a second opinion. And most advisors are going to maybe, I don't know, lie is not the word, but probably embellish to try to get an assignment, especially if they don't have anything to do, in the hopes that their client will get fatigued and learn what the real pricing in the market is and decide to pull the trigger, even if it's less than their expectations. Of course, I don't do that. We don't do that. But I just say that to tell you that that's probably one of the reasons why this year is probably the year that deals didn't close, right? Someone goes and gets a different opinion from someone who's hungry, who wants to put a business on the market. They put it on the market, it doesn't transact. So, but the reason for valuation gaps are typically twofold. Broadly speaking, there's other factors, but here are the two. It's EBITDA, how profitable your business is, multiplied by a multiple of EBITDA. Those two taken in concert kind of achieve your valuation. I mean, there's other things like, how many remodels do you have to do? And do you own real estate? And what's that worth with cap rates and implied rents and things like this? But if you just kind of take a business that doesn't have real estate, that doesn't have like crazy remodeling obligations, which a lot of the legacy brands do, you just take these two factors, you multiply them, and you get to a general valuation. At least it gets you directionally there. So EBITDA, of course, has been wildly different depending on the brand. I mean, several brands, I'm naming Wingstop again, are going to be like up massive amounts in EBITDA. Many brands are going to be up fractionally in EBITDA, but the majority of them in our industry, especially since our industry focuses on large count multi-unit franchisors, a lot of the bigger ones have been down in EBITDA this year. And so once you take a business that might be down, call it 10 to 15% in EBITDA over 2023 because of the declining consumer and because of increased costs, and then you roll it through an EBITDA multiple that might have dropped one turn in the last year because of the delayed impact of rising interest rates. People don't get that right too. They say, oh, interest rates are reducing, therefore immediately the multiples are going to increase. Well, that's not what happens. There's typically a 9 to 12 month lag, and you typically don't see meaningful change in the EBITDA multiple until the last or near the last interest rate reduction or increase has happened. So it's very much a delayed effect that can be more than a year, if not a year and a half. So you say, well, how could multiples be down by a full turn or more just in this year? We've been in a kind of a rut for the last couple of years, and that's the reason why. So when you take a business that might be down from a 6 times EBITDA multiple to a 5 times EBITDA multiple, and the EBITDA in 2024 is down 10% versus 2023, and you bang those two things together and multiply them, you may have a valuation that's down 30%, right? And that's probably the average gap, roughly speaking, of all these assignments that we saw that we didn't take in 2024. Another reason why you're seeing deals not transacting, is kind of the nature of the question, is that private equity buyers have been kind of on the sidelines over the last couple of years. Family offices too, but to a lesser extent. Private equity obviously has limited partners and general partners, and they want to sell something 5 to 7 years, maybe or so. Some of them have different flexible structures. That was brought up too on the panel about how private equity may be changing the way they look at these businesses. Their hold period, their IRR requirements are lessening a little bit in order to make the model work in a difficult market. But they've largely been on the sidelines. They want, as a general rule, increasing same-store sales, low cost of capital and plentiful development opportunities and cheap development too. And those conditions just haven't been there in 2024. And so, and largely in 2022 and 23 as well. So they've kind of created a vacuum in the marketplace. That's been a notable condition that again, I hope is going to come back. Now, someone told me, and this is crazy if it's true, but someone told me that at some of the business schools across the country, some of the professors there, and I can't remember the school or the person who told me, but I've heard it twice, almost say that like getting into franchising is a guaranteed way to do well, painting it as a great way to jump into business post studies. And I just kind of shake my head at that, right? Because it's a very difficult business to do well. But as some of the failures or some of the struggles of these early PE funds run by these young MBAs kind of come to the surface over the next couple of years, I think, these folks travel in small circles, many of them in New York and South Florida. And I think the rebound of new private equity entrants back into the franchise business will lessen a little bit from the first wave, just because it'll season, and there have been some failures that are going to get around and be heard about. Another item that we talked about was that deals have gotten more arduous. Timeframes have gotten extended in 2024. We've seen some unreasonable retrades during due diligence and arguing over small conditions of contracts. It's just what happens when you see parties squeezing, both buyer and seller and attorney and franchisor, all the parties squeezing, and it makes for, frankly, just difficult transactions that are contentious. Franchisors have, in some cases, become increasingly heavy-handed with their non-compete clauses, personal guarantees, requests for development, and then which franchisees they're approving. And this last point's a big one. Some brands we're seeing, like some of the brands that are emerging brands that are really growing and have territories where you might have 20 stores, but they need 200 stores and they've got the runway to do it. Those younger brands that may have 500, 1,000, 1,500 locations are becoming more agreeable to investor-led franchisees, whether they're family office or private equity companies. Why? Because they need an infusion of capital quickly into their brand. Whereas you have other legacy brands they're actually doing the opposite. Development's not as much of a thing. It's more about operations. It's more about maintaining the brand and remodeling the brand. And, PE has a history of not being very good remodelers and maintainers. They don't like to spend CapEx when there's not new development or increasing same-store sales. So a lot of these legacy brands have been feeling the effect of kind of tired assets and, broken agreements with those private equity franchisees. So they're actually going the opposite direction and saying, we don't want private equity anymore. We want people with boots on the ground who want to operate stores and live in the markets where they operate. So that has been an interesting trend that has been changing. And I guess all this just requires, if you're a buyer or a seller or just an operator in this environment, I guess it requires a careful pre-screening before you make a decision to buy or sell an asset. And of course, if you hear this and you talk to me a lot or listen to me a lot, I'm thankful for that. But you can always find me or anyone on our team and kind of ask our opinion or how brands are thinking across one another. We tend to keep a good perspective on, what they allow and what they think and how they maintain their franchise base. And we're happy to help and give perspectives there. So that's the second question. And then the third and final question for the day, and I've taken longer than I thought I would. So thank you for listening. This was the third question on the panel. So what is your outlook for deal activity over the next year? What are the key variables that will drive a stronger or weaker M&A environment? And a couple of examples might be, interest rates, operating environment, or consumer strength. Okay, so I guess my comment is this. Before I talk specifics, I would just say that I am now quite optimistic about the future of our country. Like many of you who are listening, I'm an entrepreneur. I run a business. And especially franchisees who might be listening, I would ask the question, where else would you want to place a bet over the next 10 to 20 years other than the United States? I still think we are the best country in the history of the world. And I'm also bullish now on the future of our country. And I think you could really feel it out at RFDC. Like I said at the top of the hour here, there just feels like a cautious optimism, like we've hit the bottom and that the next, it's like that we're going to kind of try to will this thing to turn around. And I, towards the end of the panel, I made the comment that I just made to you. And it was met with not a standing ovation, but with like a big hearty round of applause in the middle of the panel. Okay. So, which I think is very rare to see. And so I think people are wanting to be optimistic. People are wanting to change. People are going to try to will this thing to be successful. And I think momentum's a funny thing. It may hit us. I don't think it's going to hit us immediately, but it could hit us over the next 6 to 12 months. And we could really be looking at some midterm optimism with M&A activity and for our business. So there should be a steady increase of M&A activity over the next few years. Okay, there is this pent up demand that we keep talking about of people who've wanted to sell their businesses, but have just frankly been unable to do so because of the valuation gap, right, over the last couple of years. So that still is there. For the first half of 2025, I think some deals won't close, an extension of what I told you with the year of deals that didn't close in 2024. Increasing supply, now just hear me here, increasing supply of deals on the market could reduce prices temporarily in some brands. If we do get people wanting to come back to the market and sell their companies because they're ready to retire or monetize a gain, or they're just tired, and we do get a pickup in supply, I think supply would pick up before demand would. And if that happens in a large quantity in the first or second quarter of 2025, we might, in some brands where there are more sellers than buyers, see prices maybe drop a little bit. But I think that's a short-term phenomenon, but that could happen. But I do think M&A activity will pick up. It'll pick up slower than maybe it otherwise would have if Kamala Harris had won, which in that case, people would have been running for the hills to avoid higher taxation on the sale of their business. And so 2025 probably would have been a bigger year than otherwise, for that reason, kind of like we saw in 2021 when folks were afraid that taxes were going up under the first year of the Biden administration. But now that is largely a non-threat, I think people will be a little bit more deliberate and probably want to operate their business a little while and hope for some year-over-year increases before they sell, also with dropping interest rates potentially helping them. So the two biggest challenges that we have right now are a consumer problem, and we have way too many restaurants. And along with some of the regulatory policy we have in our country, these things will take a little time to fix. There's no quick answer or solution, especially to the consumer problem and too many restaurants. And I think lowering interest rates should strengthen M&A, and we're probably going to see some more interest rate reductions in the next several months and into 2025. But people, again, like I said earlier, they overestimate the importance of that. And they also miss the timing that, again, you really don't see meaningful changes in buyers coming to the market and rates dropping and deals getting, more attractive until probably 9 to 12 months after the last of the major rate increases happens or decreases happens. So I think sales and EBITDA increases are just much more important than lowering interest rates, although lowering interest rates will help marginally, of course. I'd guess that probably 10 to 15% of our country's franchise restaurants need to be closed. I mean, it's a bold statement, but I think it's true. Every deal that we see these days, not every, but most deals that we see these days when a franchisee comes to us with 30 restaurants, they've got like 5 or 6 that need to close. And some franchisors are very difficult to get a store closing. You have to pay like penalties, 2 years or a year of penalties on royalty and advertising just to close a store. Some brands are a little more open-minded and say, if a store is unprofitable, shut it down. Some of that runs along the lines of whether they're a publicly traded company or not, right? Or whether they're about to sell to a private equity company, because those franchisors are really incentivized by store count and new unit growth. But Pareto's rule is in effect. 80% of your problems come from 20% of your problem stores. And I think that's probably, a good rule of thumb, Pareto's rule for the stores in your marketplace and in your portfolio. And I would just say continue to be dogmatic about having the right number of stores and the right number of profitable stores, and don't fall in love with a store that you've held for 40 years that's no longer profitable anymore. I see that being a big issue, especially with legacy franchisees, that they can't let go and can't look at things objectively if a restaurant is not performing and won't perform in the future. If you're a seller of a good business, then sell it whenever you want to sell it. There will be good prices and plenty of interest. And that's been true in 2021, also in 22 and 23 and 24. And that'll be true in 2025. There's no doubt about it. Good businesses, like I said earlier, will sell at high prices. no matter when they sell. If you are a seller of an average business, the timing will be important to balance what hopefully will be increasing EBITDA in 2025 over 2024 with the minute-by-minute fluctuations in supply and demand. We talked about like Carroll's being acquired by a Burger King corporate. At some point, it's possible that those stores get refranchised. And if that happens and you happen to be a seller of a Burger King business when there's all of a sudden tons of businesses on the market in that brand, you can understand that timing might result in lower values, right? So, I mean, that's just one example. It's not meant to single out any brand. I mean, it happens in any brand that's going through any change. If there's a big refranchising program that's happening in any brand, they usually flood the market with deals. And so that's just one example of how you might, in a legacy brand, want to be careful about how you time an exit of a business. If you're a buyer, it is probably a good time to jump back into the market if you're inclined to do so. Lowering interest rates will help you, right? And valuations have come down. And so if you agree with me that we're going to go on a good run and this is still the best country in the world and our business and our industry is going to survive and it's going to thrive over the longer term, and you may not take that view, but if you do, then it would seem like we're near the bottom of the trough of a time to get back into the space and maybe acquire if you see something that you like. I just would say that I project, Unbridled's revenue in 2025 will probably be flat to 2024, but ramping up in the back half of the year. But then I think that 15 to 20% compounded annual growth per year in 2026, 27, and 28 is, if not possible and probable, is very likely unless we hit some seismic macroeconomic problem that hits us. So I think the future could be very bright. I say put on your chin strap and let's go get them. Let's be optimistic and let's make this next few years be really impactful for all of us. And then I left the convention with a funny little quip. 3 of my alma maters, the Naval Academy, Illinois, and Vanderbilt, have historically been very bad football teams. But in 2024, as we sit here, all 3 of them have winning records. And I said, hey, man, the last time, if you make a guess, when do you think the last time all 3 of those schools had a winning record in the same season? 1982, almost 43 years ago. And so I kind of joked that that's a good omen, right? That's got to be a good omen for a rebound in our industry in 2025. So again, I remain optimistic. I wish you guys the best. Overall notes otherwise from the convention were kind of a similar sentiment. There was a really nice discussion with Malcolm Jenkins. He was kind of one of the guest speakers on the main stage on Monday. He was a former NFL player. I think he might have won a couple of Super Bowls, and now he's a franchisee of a couple of brands. And his story was neat and optimistic. On Wednesday morning, we had Dennis Monroe, who's a longtime attorney, interviewed Greg Flynn, the largest franchisee in the world. And he talked about his story of getting into the Applebee's brand and then how he got into Taco Bell and then all the other brands that they're now a part of. That was interesting to hear. Overall, the message of the convention was constrained or restrained optimism. We still have, in the lender community, I hear a lot of picking and choosing. So I hear a headline that they're optimistic, but then when you pull it back, they're very choosy on which brands, which geographies, and which situations where they'll lend. They continue to want to have deposits if they're going to make a loan, which is interesting. But I just think the lending community is choosy, but the overall tone is one of optimism. And so that does it for this episode of The Boiler Room. Happy Thanksgiving and Merry Christmas. Let's stay in touch and let's go get them for 2025. I'll talk to you soon. Thanks so much for entering the Boiler Room today. You can find our podcasts on iTunes, Google Play, Stitcher, TuneIn, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A and financial resources in the industry. Our website includes webinars, podcasts, videos, white papers, and a list of our past M&A transactions. Please note that neither Rick Ormsby nor Unbridled Capital Advisors LLC give legal, financial, or tax advice. These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on such information, errors therein, or omissions therefrom.